Hello, everyone. Thank you so very much for joining us today here at the Spectrum Group. My name is Randy Wostratzky, joined by Kent McDill, one of our senior writers. It is the May 2019 readout of our latest investor confidence indices, both the affluent and millionaire wealth segments. We're going to go into our investor confidence indices for May of 2019 with Kent.
Thank you, Randy. I'm going to cover the April investor confidence indices, which indicate that investors are not convinced the stock market tells the tale of the economy or the shape of household finances in the spring of 2019. The research for the April confidence indices was gathered in mid-April and concluded on April 22nd. The next day, both the NASDAQ and the S&P 500 reached record highs, and the Dow Jones Industrial Average flirted with doing the same, but investors were unconvinced that those numbers reflect the economic picture. As this chart shows, the Spectrum Millionaire Investor Confidence Index rose 2 points in April to 8, but this marks the fourth consecutive month in which the SMICI has moved opposite of the direction it moved the previous month. As shown here, the SMICI is exactly where it was 1 year ago, and it is only 1 point above where it was in November of 2018. The SMICI is a measure of confidence among investors with $1 million or more in investable assets. The Spectrum Affluent Investor Confidence Index, indicated here on the bottom of this chart, which is for investors with $500,000 or more of investable assets, dropped by a single point in April, but it's also 5 points below where it was 1 year ago, and it has not risen above 4 in more than half a year. As this chart indicates, the Spectrum indices spiked in November, but have remained in single digits or even negative numbers for the past half year. The bottom chart shows that the indices have been generally lower since 2017, reflecting the uncertainty which investors feel apparently over the long term. But it's this information which shows just how many questions investors have about the state of the economy versus the state of the markets. Despite the record numbers in the markets, investors in April pulled away from investing in all categories of products, both in terms of equities and in bond markets. The interest in bond investing was almost halved among all investors, and there was a drop of almost 9% in stock mutual fund investing. Among millionaires, interest in stock mutual fund investing fell to 27.9%, the lowest level since May of 2012. The indices show that interest in additional investing in bonds and bond mutual funds was higher in April among non-millionaires than it was among millionaires, and that's a rare occurrence in the history of the Spectrum indices. The percentage of those investors not investing, which describes investors who are not going to add to their portfolios in the coming month, rose to 50.4% among non-millionaires and 34.9% among millionaires, notably high levels in both categories. The Spectrum Household Outlook, which asks investors to consider the impact of current economic conditions on 4 components of household finance, was relatively steady for the third consecutive month at 21.2, which is twice as high as it was in January, but well below the 30.2 rating it reached in September. The lack of movement shows that investor outlook was stable, but not gaining steam despite the rising stock market numbers. This slide shows a lot of red. The numbers are small, meaning the outlook generally is dim but not devastating. The outlook seems to indicate investors are in a holding pattern to determine how international relations are going, with the whole idea of tariffs being issued against countries both east and west of us. And corporate returns are failing to engage investors, even though in many cases they're very good. Note that the outlook for the economy is 14 points below where it was a year ago, and just a few months ago it sat in negative territory. Investors apparently believe strongly that the stock market does not necessarily reflect the strength of the economy.